Student, as we have discussed in the last class that there is one concept of external funding requirement. So we have discussed one question of the same that is has come into January 2021 examination. So I am just continuing on the same. Please have concentration. That is one by this we have make it tabular form, and another is version is formula version. Now in the last class, because before I was closing the my chat box, I saw there was e query. Sir, in examination, which method we should follow, whether tabular presentation or formula based? Student, it is up to you. You can follow either of the way, because in that case you will get full marks. There will be no deduction of the marks because this is an alternative manner of presentation only. Okay, so don't worry on that part. Okay, now student, continuing our discussion, let us go back to the solution question. As I told you when we were discussing, here they have put some conditions. Okay, the management has put some conditions that they should meet this criteria also. Okay, now let us see how can we meet this criteria. Okay, I will solve in the both manners, that is amount and in a tabular manner as well as in our formula base. Okay, let us see the solution for it. First, we jot down the conditions. What are the conditions that we have to meet? Sales to short-term loans and payable and provisions should be 4:3. Okay, this is one of the condition. Another condition, ratio of fixed assets to long-term loans 1.5. Okay, this is given. And last is debt equity ratio should not exceed 1.5. Okay, now student, when we have computed all the, we have see all these conditions. Now we see how much amount we have to raise from the short-term loan. Okay, now amount to be raised from the short-term loan. One minute. Let me see. Is there any? My voice is not audible. Let me check. Mr. Mansukh? Mr. Mansukh? Mr. Mansukh? Audible, na? Because there is one query student is saying my voice is not audible. It is really audible, na? Okay, okay. Then I can continue, na? Okay, okay, no problem. Okay, student. So please check it at your end. Now here, let us see how we can amount to be. I'm just taking it on the next page. Okay, student. Now here it says net fixed assets. Our should be that there it has been given ratio of fixed assets to long-term asset. Okay, it has been given to us. Okay, now let us see. Oh, sorry, first condition is short-term loan. Okay, now let us see. First, let us go by the first condition. New amount of short-term loan and payables. Okay, student. See, students. Here the ratio should be 4:3. It means if our sale is 4, then the amount of short-term loans and payable and provision should be 3. Okay, accordingly, our sale is since 720. So the amount of short-term loan and provision should be this much. Sorry, my mistake. It shall be this way. Okay. Accordingly, the amount should be 540. Okay. Now less existing amount. Okay, of short-term loans and payables. Okay, student. Now see here, it is very important to note this payable amount will be increased proportionate in the proportion to the sales, but there will be no change in the short-term loan amount. Okay, so let us see. $200 short-term loan payable amount. The increase is 20. Okay, the new amount will be this plus existing amount of short-term loans. So the amount comes 540. So if maximum amount that we can raise from these sources is 540, and already we have amount of 540, so we cannot raise any amount from the short-term loans. So the amount can be raised from short-term loan will be nil. Okay, now next we are coming to, I'm just taking it on another page. Amount to be raised from long-term loans, long-term funds. Now here it says the condition is it should be 1.5. Okay, it should be 1.5. Okay, amount to be raised from the long-term loans. Okay, new fixed assets. So first of all, we draw out the table. One second, student. The amount will be 600 was existing amount. Okay, proportionately increase. Okay, the amount comes 720. Okay, now the new term long term loans maximum that we can afford is sales divided by 1.5. Okay, so our sale is 720. If we divide it by 1.50, the figure comes 480. Okay, so maximum loan we can afford is 480 for the long term loans. Okay, less existing long term loan. Okay, students. The maximum amount that we can raise is 80. Okay, now we come to third point. We have covered 2 points. Now we are meeting the third condition. Okay, students. Now, if we go by the condition, that please check the condition. The debt equity ratio should not exceed 1.50. Okay. So let us see this condition, how we can meet this condition. Our EFR, okay, is basically 2 to 5.60. Okay, less amount to be raised from short-term loans, that is nil, that we have seen here from this table. Okay, then we come to another item 80. Okay, let us see. Less amount to be raised from long-term loans. This is 80. Okay, so ultimately the balance we can raise it from the equity. Okay. Now it says that we have to meet the condition. Okay, we have to meet the condition that it should not exceed our 1.5 ratio. Okay, now let us see the new debt equity ratio. Okay, so our here overall debt is old debt was 400, and our here it was 480. So our new debt are 480. Okay, our existing equity is better 300. Okay, beta. This is reserve 200. Okay, and this is our addition 1440. Okay, because it is our part of our retained earning. Okay, beta. Now let us see. So we put each and every item like 300 equity. Okay, madam. And this is our 200 retained profit plus 14.540 this. Okay, plus very important, this additional equity. It will also come here. 145.60. Okay, now just solve it and get the answer. I am just giving you 1 minute. Meanwhile, let me check if there is query. Beta, there is one student is asking, sir, previous class lecture, will it be uploaded later? I think it will be uploaded in 1 or 2 days. Please have some patience. Certainly it will be loaded. Don't worry. Okay, beta. Now just give me the answer. I want to see on the screen. What is the answer? That won't be in short-term debt. 0.73. Sairam, your answer is correct. Somewhere near about 0.73. Student is asking, sir, very good doubt. Sir, can we include the short-term debt? Of course, better you can include, but basically there may be some difference in the interpretation, because normally debt equity always implies a long-term debt, because short-term debts normally are raised to meet the short-term requirement, and normally they are refunded during that, say, within the period of time of 1 year. Okay, so that's why normally the debts are normally, when we talk about the solvency of a company, so long-term debts are more emphasized. Moreover, even if we include here, so whether we see whether the condition will be breached or not, ultimately the answer will be somewhere around I think it will be, if I'm not wrong, let me check again. One minute. Of course, the answer is 0.76. Okay, yes, the condition is met. Now, if student is saying, sir, can we include the short-term debt? Okay, let us see, even if we include the short-term debt, whether the condition is met or not. Because there will be no raising from the short-term loan additional, even if we include 300. So let us see whether the condition is met or not. Okay, let us see, no problem. This can another alternative also. Yes, even if the condition is meeting. Condition is meeting. Okay, student. So still there will be no problem. Even if we ask Divya, you are correct, it will be 1.182. So still, if we are meeting the condition, then there is no problem. Okay, student. Now, can we move to the another version, formula version? Okay, we have seen the external, in the first version, we have seen the external funding requirement. Now I am taking you to the short-term fund requirement. From formula version, we have computed the EFR. Okay, but however, we have to see the conditions format. We can use equations. Okay, we can use the equations. Short-term fund requirement. Okay, let X be the new short-term loan, short-term loan, meeting the condition required. Okay, so our condition is there should be a proportion of 4:3. Okay, so our existing sale is 600. Increase is 20%. Okay, student. Our existing loan. Okay, this is our payable. This is our payable. So this will be increased proportionately into 1.2 on this line plus X. Okay, because we are assuming that the new amount of the short-term payable will be this much X. Okay, student. So now let us proceed further. Just find out the amount of X. Yes, student. Sairam, your observation is correct. In suggested answer, there is some error. We have mentioned instead of 720, we have given 600, but there will be no change in the final answer. Don't worry. That I am going to tell you just after completion of the question, but I'm happy you are very vigilant like this. Thank you, Sai. Okay, student, just give me the value of X. Very good. Divya, your answer is correct, beta. Okay, students. The value of the X will be 300. Okay. So you can say new short-term requirement. Okay, rupees 300 lakh. Okay. Next, existing amount. Okay. So the additional requirement will be, very good, Naveen. Your answer is correct, beta. Yatin has also given correct answer. Prerna, very good. Okay, beta. So we see our first part is over. That is relating to short-term loans. Now let us come to the second part, long-term fund requirement, long-term loan. Okay. Then meeting the required condition. Okay. So our long-term requirement condition 1.5. Okay, fixed aside to the long-term loans. What is the answer? Student, please give me the answer. Very good. Divya, again you are the first. So the beta answer is 480. Okay. Okay, beta. So additional amount that we can raise is 80. Now we are coming to third part. Okay. Less short-term loan. Prerna, I think Naveen, your answer is correct. Muthu Lakshmi, your answer is correct. Prerna, but just again check it. Okay, there may be some. Just again check it. Yatin, your answer is correct. It may be possible that when a student you may have mailed your answer, but there may be some time. So don't worry, your answer is reaching to me. So balance amount will be raised from equity. Okay. Now we have seen the new debt equity ratio. So it can be taken both way. This will be the same. This answer will be the same. Okay, student. So I hope with this, the concept of EFR meeting the various conditions must be clear to you. Okay. Now I am coming to the next topic. One second. Okay, student. Now, till now we have discussed till now this till this point. I am coming to one important strategic decision. Okay, that is called bond refunding decision. Student, what happens? Bonds are normally long-term assets, and since it involves a fixed commitment of the interest, so what happens? Sometimes a company may decide to refund the bonds. Normally, it decide to refund the bonds when they say they want to save the cost. Now, just I give you just read the slide carefully, then I discuss it with you. Okay, you may not find this in your first chapter, bond refunding, because this topic is mainly relating to your topic chapter number. I think it is a 4th number chapter, security valuation, where we shall discuss the bond in very detail. But here, I just want to give you a glimpse of how a company can take the strategic kind of a decision, and it is one of the kind of strategic decision that may be taken at a corporate level. Okay, that the finance department, or even it can be taken at a functional level. They can suggest to the corporate and the company's board that we should refund the old bonds that is existing. Just you read the slide carefully, then I discuss with you with a practical case study. Now here it says it is a kind of a strategic financial decision, and the capital budgeting method is used to evaluate the decision to refund the existing bonds and the issuing the bonds of an equivalent amount. The NPV method, that I need not to tell you because you have already covered at your intermediate level, is used to evaluate such type of bonds refunding decision. If present value of cash inflows in form of net cash saving, that is most important, because see, I just give you a very small example. Of course, I will next example I will say what happens because whenever market when any company goes into the market and raise the bonds, of course they will offer the bond at a rate which is prevalent in the market somewhere nearby. Okay, although there may be some adjustment on account of say credit rating, because if the credit rating is lower, of course the company will have to issue the new bonds at some premium because the investor is taking some risk. Okay, and as we have discussed in the risk return trade-off, if an investor is taking more risk, he will expect more return. Okay, so what happens? the company may have issued at a higher rate of interest bond, but later on, if the interest rate coming down, okay, then company will start feeling that why should I pay the more price for the same? Okay, why should I pay the more interest? What they will do? They will refund the old bonds. Okay, they will refund the old bonds and they will issue the new bonds. Okay, so whatever is the saving on account of difference, that will be our inflow. Okay, that will be our cash inflow. And what will be our outflow? Call premium. Call premium, student, I just tell you what happens whenever a company issues a bond. Moreover, I will also explain you when I will take up the question. Whenever any company issues a bond, they generally issues with the call option. Call option means whenever they feel, right, they can refund the amount of bonds to the holders. That is, they hold the right. They hold the right before they can exercise a right to refund the amount of bonds before the maturity period. Okay. And even more important, interest during transition period. It is very important. What exactly is transition period? Transition period means, see, there is always a time gap because there may be take 1 or 2 months before the new bonds are issued and old bonds are refunded. Okay, so in this period is called transition period. Okay, I will just explain you also on the notepad when I will these bond terms I will answer. Then existing bonds can be refunded and the new bonds carry low coupon interest rate can be issued, resulting in saving of the cash flow outflow on account of interest. Okay, now in this case, I just quote you one. This is the latest example, and reference is the Economic Times of just 18th October. Okay, just read the slide carefully. Okay, now it says embassy office rate, basically real, we can say real investment. RET means real investment trust. Okay, this is kind of a mutual fund that we will discuss in the topic of mutual fund, but just for the time being, you just understand. Has raised rupees 400 crore debt at an interest rate of, or this against of its debt at embassy, repaying its existing debt. What is doing now? They are coming out with the issuing at a rate of interest of 6.5%. The proceeds from the debt raised from the mutual fund and insurance company will be utilized by the embassy rate to repay its existing zero coupon bond. Okay, so they have raised the 200 in the 2009, somewhere amount this much. Okay, so they will use this amount to refund. This amount will be used to refund this amount. Okay, of course, there is a difference of 70 crore. Okay, where this can be on account of flotation cost, etc. With this refinancing, the consolidated debt cost reduces to 6.8% from the original 9.4% at the time of this date, thereby significantly reducing the interest cost. So I hope it must be clear to you, the company is strategically taking the decision that why should I pay 9.4% when easily I can just cut my cost of interest burden to 6.8%. Okay, I hope it is clear to you now. Okay, now let me see the query, then I will proceed further. Okay, student, let us see further. I'm just taking to you the before I think there is this question, bond refunding question, third question in your assignment. Okay, you must the assignment will be you, must be you with you, and I just share the solution with you now. Now this is the question number 3 with you. Okay. Now before I discuss the solution, just read the question carefully. DEF Limited has outstanding 10% callable bonds, 20 crores that has a 10 years of maturity. Okay, so the rate of interest existing coupon is 10%. The call premium is 7%. What is call premium? I will explain to you. Of par value of the bond, since the company has for the last some year due to falling interest rate in the market can issue 10 years. That is same year. Okay, same tenure. Okay, bonds with the same features. Okay, at the rate of interest of 8%. The flotation cost of the new issue is expected to be 60 lakh. Okay, should you advise the company whether it should refund the bond and issue the fresh at a lower rate or not? Okay, now let us see. So first of all, what is this call premium? Basically, beta, as I told you, the company have a call option, call provision, you can say call option. According to this option, the company can refund the bonds before its due maturity period. Okay, it can refund the bonds before its due maturity period. Okay, for doing this, what they have to compensate the shareholders. So here they are giving the compensation of 7% because they will have to pay the premium. It is not the choice is not free to the company that they can whenever they are come as per their own whims and fancies, they can refund the amount of the bonds. No, they have to ultimately they have to pay some premium. Okay. Now next it says, next point is I am just discussing interest during transition period. Moreover, in this question, there is no transition period, but sometimes there may be transition period. For example, in this question, we are assuming as soon as the company will refund issue the new bonds, the old bonds will be refunded. There will be no time gap. Okay. So, like for example, I am just giving an example, not related to this question. The company issues the new bonds. I think there may be some problem. One minute. Okay, beta. Now what happens? It may be due to some problem. Now here you see the interest during transition period on a 1/10/2020. Okay, the company issues new bonds. Okay, on 1/12/2020, the company refunds the old bonds. So this is during 2 months. Okay, the interest burden will be interest on new plus interest on old. So this extra burden will be additional cash outflow. Okay, you got this point. So during this period, I just give you another example. Like nowadays there is no question of manual book accounting. Hardly any trader or any businessman is maintaining the books on books of accounts on a manual basis. Of course, in your articleship, you may come across some traders may be following the manual accounting. But there was a time when I was doing my CA, so computer accounting was almost very rare. Okay, it was very daydreaming like that because there were used to be very big ledgers, etc. Now, when with the coming the very cheap software in the market, the even small businessmen have started moving from the manual accounting to computer accounting, and even in the big organization like corporate sector, they are also starting to following establishing the system of ERP and even more sophisticated system. Now, what happens whenever it is very practical? Okay, whenever we switch, whenever we switch from this is our existing system. Okay, and when we move to another new system, so I remember when I was used to work, my one organization has shifted completely their accounting from manual to this your mechanized computerized accounting. So what we have done initially, at least for the 2 months, I remember that it was maybe 2 or 3 months, we have done both work. That is, we were maintaining books manually also, and we are doing the entries also in our computer, and we are matching day by day, and we are testing the system whether it is working or not. So I think it may be after 3 months, because I remember after the closure of the year, from the fresh year, we have started fully from the new system. So this period is basically called the transition period. So similarly, case happens in the case of a bond, we have to pay some additional amount. Okay, now I'm coming to the solution. First of all, we have to see what is our initial outlay, like capital busting decision. In capital busting decision, what is the formula? Present value of cash inflows minus initial outlay. Okay. Thank you, Prerna. Okay. Now, first of all, we have to pay call premium. Okay, how much call premium? It is 7%. One minute, let me write here. It is correct, only just I am putting it in a scale properly. Okay, so first is coming our initial outlay. Call premium. Okay, 1.4 crore, that is 140 lakhs. What is this 60 crore? 60 lakh is my flotation cost. So ultimately it is 200 lakh. Okay. Now we are coming to annual saving. Old interest payment at the rate of 10%. This is 200 lakh. Okay. That is 2 crore. Okay. So ultimately 40 lakh saving will be for the 1 year. So we have computed our 2 working notes. One is initial outlay, another is annual saving. Okay. Let us proceed to further. NPV of the bond refunding decision. Okay. Now our saving is of 40 lakh rupees. Okay, student. In the question, we have been given the present value factor. Okay, we sum up this practical factor. Now here, student, there is one question comes to the mind of a student. Whenever in the question in the examination, if you have been given the present value factor, okay, you should consider them. Okay, you should consider them only, because normally here the important consideration is of a decimal point. Okay, in order to maintain the uniformity in the answer, normally this kind of a table is provided in the examination. Okay, so here you can see that at the present value factor or the rate of 8%, the factor is 0.926. Okay, so if you round it off up to the 2 decimal point, then the value will become 0.93. To maintain the uniformity, the normally this kind of a table is provided. Okay. Now we add up this amount. I forgot to draw the table. No problem, just I'm writing here. Okay, student. Now initial outlay. Okay. So our NPV will be 60. Thus, we should refund the. Okay, student. Do you have any query so that I can proceed further? Okay, student. Now I am coming to the back to the PPT. Okay. Now we are coming to next theoretical topic: interface of financial policy and strategic management. So, students, so far as this it is concerned, it is almost a theoretical thing. The interface of strategic management and financial policy will be clearly understood if we appreciate the fact that starting point of an organization is money and the end point of the organization is also the money. So ultimately, we start with the source of finance. Okay, we change our capital, we modify our capital structure, or we design our capital structure. We make the decision regarding investment and fund allocation, and ultimately, in the end, we make the decision about the dividend policy, that how much we have to retain and how much we have to distribute our stakeholders. So overall, we can see that the ultimately the interface of strategic financial policy and strategic money is basis the funds or the money, that is basically the foundation of both decisions, and that links together. Now, just read the slide carefully. It is only from your study material. Meanwhile, just I have received a query. If in the question we write answer to 3 decimal points in crore, will it be considered? Of course, beta, it will be considered. Please see, in case if any instruction have been given to you in the examination, like they may give you that you have to round off your answer up to 2 decimal point. So you have to go by the same. Otherwise, 2 to 3 decimal, even 4 decimal point, your answer will be considered correct. There is no problem. Okay. And another question is the decision taken based on the assumption that further the interest rate of bond will not go down further in this 10-year tenure? Of course, beta, actually see what happens. Kishan, your question is very valid question. In finance, if you see, everything is based on estimation. Okay, only problem, because nobody knows the future, but we have to make some prediction for the future. Okay, of course, they make some prediction like interest, because it is just like somewhere at some point of time you have to take a decision. For example, I'm just quoting an example, but don't consider it practically. If say I buy the share of any company at say rupees 50 per share. Okay, now tomorrow if rate rises to 100, so now I will be in the dilemma whether I should hold it or I should wait for some time, because it can go further. But it may also be possible that they may go down also, because it has practically happens. The shares who were trading at a 5,000 rupees, they are trading now at 10 rupees also, even below that. So this is a practical thing. So somewhere I have to take some decision. Similar in that case, I have to make a decision. Of course, okay, our benefit, like here we have carried out our NPV analysis. Okay, and from the NPV analysis, we are saving some money. So of course, we can take a decision. Okay, student. So we can see that ultimately, when we talk about financial policy and strategic management, it is a combination of various decisions like what should be our capital structure, that is the desired mix of equity and debt capital, because we have seen that if you recall that you are intermediate where you have to design the capital structure in such a way that your cost is minimized, and there are some theories like net operating income approach, net income approach, okay, Modigliani Miller approach. So there are some approaches are there. Investment proposal mooted by different business units may be divided into three categories. Now these I need to explain because you have remembered that for addition of a new product by the firm, that is very common. You want to launch a new product. Increase in the level of operation of an existing production through either increase in capacity or existing plant. Okay, cost reduction. Okay, efficient utilization of resources through a new approach. A closed interface is needed to frame the policy to benefit for the beneficial to be on. Okay, madam. So I hope this is a theoretical thing. You can understand. Now I'm coming to one of the very important topics: sustainable growth rate. Okay. Now just read the slide carefully. I just discuss with you what exactly the sustainable growth is. Now, sustainable growth is important to the enterprise long-term development. Too fast, too slow growth will go against enterprise growth and development. So the financial should play important role in enterprise development, adopt suitable financial policy initiative to make sure that enterprise growth lead close to sustainable growth rate and have sustainability, healthy development. Student, I think if you just think that sometimes what happens, of course, growth is good, but too much growth and too much less growth both are dangerous to the organization. Okay, for example, just I give you a very small example. Someday 1 year around 2 years back, there was some new. I was just watching the news. So there was saying one person is very tall in height. Okay, so he is facing the problem. Okay, for moving into the bus, just coming out of the room, because even his head is touching to is far is above the door, size of the door. So of course growth is good, the height is good, but if it is going unlimited in going in an uncontrolled manner, so then it becomes a problem. Similarly, when the organization grows at a very high speed, so what happens, the expectation of the stakeholders becomes very high. Okay, but if it could not achieve that growth, so then it becomes frustrating for the stakeholders. Similarly, if the company growth is very slow, very low, this will also, so ultimately you have to maintain some balance. Okay, you have to maintain some balance somewhere in between these two extremes. Okay, so by this you get, like, it is kind of an average kind of a thing. Okay, it is kind of a average kind of a thing. So you have to maintain this growth. This is called sustainable growth. The strong concept of sustainability is concerned with the preservation of the resources under the primacy of ecosystem. Now, student, there is one concept you must have studied: ESG. Okay, environment, sustainability, and governance. Okay, there is a new concept has come into the picture. Not new concept; it is an old concept, but now it has started gaining the importance. Now there are some guidelines are also there that ESG reporting has now become mandatory for some companies. So ultimately, now the awareness regarding to environment, okay, preservation of the resources is very important. Okay, sustainability means you have to survive. There is no hampering on the, there is no denting on the survival of any company. Environmental sustainability and governance. Governance means the management of the company should be in a they should not indulge any fraudulent practices. So this framework is a new and is a gaining the importance ESG framework. Okay, you should have some idea about the same also. Now, what are the key growth rates? Every organization, there are some key growth rates that are important. Just read the slide carefully, then I discuss with you. Growth is often the central theme of corporate planning, as normally firms state the corporate goals in terms of growth rate, that we are rising at that much of growth rate. While firms may be interested in growth, they may be reluctant to raise external equities, because it may be possible that, of course, the growth is good, and for growth we need funds. But sometimes it may be possible that the company may not be interested in raising the additional equity because losing of dilution of the control. Keeping in this reluctance, it is useful to calculate the true growth rate for the long-term financial planning. Because see what happens, it is not always easy for a company to raise the equity again and again. Normally they raise the, because they can issue the bonds very quickly. But issuing the equity is a very daunting task because there are a lot of formalities are involved. Of course, there is a dilution of the control with the existing shareholder also. So they not be ready for the existing shareholder, not be ready for the issuing the new equity. So these two growth rates, that is internal growth rate and sustainable growth rate, plays a very big role in the fundraising, that is financial goals. Okay, the firm's growth rate is higher when external funds finance are used. It is lower when internally generated funds only to finance. See what happens. Here I will draw your attention on a one concept, that is trading on equity. What is the concept on trading on equity that you have discussed in your intermediate level? Trading on equity means when the rate of return on the investment is more than the cost of interest. Okay, so there will be ultimately increase, or there will be you can say appreciation in the EPS of the company. That is called trading on equity. So similarly, what happens when a company is growing? They needs funds. So of course they are plowing back their profit. That is called retained earning. Of course they will grow by the same. But what happens when they use their retained funds? The growth may not be that much that they are expecting. Okay, because lack of funds. So if they go for external borrowing, then of course the growth will be on a higher side. So let us see. This is called, when we company use external funds, this is called sustainable growth rate. And when they are solely dependent on the internal funds, that is called internal growth rate. Just read the slide carefully, then I discuss with you. Okay, student, internal growth rate is the maximum growth rate that can be achieved with no external financing whatsoever. Growth rate that can be sustained with retained earning and represent internal finance. Okay, so it means we are not resorting to the external financing in any manner. To determine the internal growth rate, we make the following assumption, that assets of the firm will increase proportionally to the sales, as we have done in the external funding requirement. Okay, the net profit margin, net profit to sales is constant, because we assume that this will remain constant. The dividend payout ratio is given to us. Only then we can compute how much will be plowed back in the organization. The firm will not raise external finance. So this is a prime condition for the internal growth rate. Okay. Now these are the variables of IGR, net profit margin, asset turnover ratio, and retention ratio. So net profit margin ratio, I need to tell this is net profit upon sales. Asset turnover ratio is equal to sales revenue to the total assets, and retention ratio is means 1 minus D. 1 minus D, that is how much we are retaining. If company is paying the dividend of 30%, so of course 70% will be our retention. Now student, this is the formula for the IGR. Just note down the formula so that we can proceed further. Okay, so here you can see net profit margin into asset turnover ratio. Okay, so if we just, I'm sharing with you just on a slide, just see here also. I think I need to, I can do like that. Now student, we have seen our net profit margin into asset turnover ratio. Okay, so our net profit margin is basically net profit upon sales. Here it is sales upon total assets. It is strike through. Okay, the figure becomes this becomes return on assets. Okay, student, clear? And then we got the figure of ROA here. From this, we can calculate the IGR ROA into plowback ratio, that is 1 minus dividend payout ratio, or this, we can use either of this formula. Okay, there is not an issue. Prerna is asking answer in the 1 minute, I think in the question. Koshani has asked one question. Just Koshani, I just take 2 minutes. I will just let me explain, then I come back to you. Prerna is asking, sir, we should remember the assumptions for internal growth. Student, from theoretical point of view, you need to remember, not in worry. Kushani, I will take your question. Just let me complete the same. Okay. Okay. Now this is the question. Just try it at your end. Okay. Meanwhile, you just try the question. I just discuss the query of Kushani. Sir, in question number 2, while calculating long-term loans, new fixed asset 600 into 20. But when we see increase by 20, only and yes, Koshani, sorry. Koshani, please see better. In the question, it has been mentioned. Let me see the question. In the question, it has been mentioned that sales for the year 600 lakh will be there. The sales are expected to grow by 20%. Now, students, see, of course, we can assume, of course, it is but natural the growth. This will increase here, but normally, if nothing has been mentioned, then you will presume that your fixed assets will also increase, because in question number 1 I have considered different scenarios, where in scenario 1 I have clearly mentioned that there will be no change in the fixed asset. Okay, otherwise in the question, if nothing has been mentioned, then you will have to assume that all will increase. Okay, very good query, questioning. Very good query. Okay, student, what is your answer? Please tell me. What is the internal growth rate? It's very simple. Very good. One student has given. The answer will be better 3.5. Answer will be 3.5. Okay, because our net profit ratio is 5%. Our asset turnover ratio is 1. Okay, so we will multiply, it becomes 5%. And when our retention ratio is 70, so our 70 into 5%. Okay, 70% into 5%, it becomes 3.5. If we use the other formula, the answer will be 0.3. Okay, somewhere 3%. Okay, it will be the 3. So I hope the internal growth rate is too clear to you. Now I am coming to sustainable growth rate. Now please read this slide carefully, then I discuss with you. Okay, it says SGR is the maximum rate at which the firm can grow by using internal retained earnings as well as additional debt, but without increasing its financial leverage. That is changing because they don't want to increase the debt equity ratio. Sustainable growth model assumes that the business wants to maintain target capital structure without issuing new equity, maintaining target payment ratio, dividend payment ratio, and increasing the sales as rapidly as the market condition allow. Because it is very essential that it is very important that the market should be favorable to you for the increasing your sale. Okay, you cannot increase your sale at your own wish. Okay, you have to see the market conditions. To determine the sustainable growth rate, the two additional assumptions are made. The firm has a target capital structure which it wants to maintain, and firm does not intend to sell the. So this is basically these two additional conditions make this SGR distinctive from the internal growth rate. Okay. Now, student, here just I need your attention. Wherein our earlier example EFR, wherein we have to observe that the passage of the with the passage of time, the company's total because though there will be an increase in total sales, but that will be remain same even if they can be reduced if the sum part is better. Now, if you recall your EFR, so what happens with the passage of time with the retained earning? Your debt normally reduces. Normally debt are reduces. So you can what you can do? You can use your raise a new debt and refund the money. They can maintain the growth, or you can generate a more growth. Okay, so sometimes firm views the existing debt equity ratio as optimal and keep it in the view firm can grow in case company wishes to maintain a particular debt equity ratio. And so these are prominent conditions. Accordingly, SG can be defined as a rate of return that maintains a constant debt ratio and does not sell this. Okay, SGR is calculated in the same manner as IGR, with only the difference that SGR we need to consider retained earning plus matching that in line with. So this is the basis. This is the basis. Okay, now this is the formula. Okay, the formula is like that. ROE, that is return on equity. That is return on equity into retention ratio. Okay, or ROE into B upon 1 minus ROE into B. That's the same way that we have done here. Here, only the difference is that instead of ROA, the difference is here of ROE only. Okay, students. Now, when I talk about of ROE, I draw your attention to one of the concepts you have discussed at your intermediate level. Intermediate level, just recall it. What is this formula? I need the answer from you. This is return on equity. Please put pressure on your mind and recall what is this formula all about. Yes, it is a DuPont formula, if you recall that. Okay, so in DuPont formula, the formula is that profit margin into asset turnover ratio into equity multiplier. Okay, so correspondingly, this is profit margin, this is sales asset turnover ratio, and this is total assets upon equity. Okay. Now, before I proceed further, let me check if there is any query so that I can proceed further then. Very good. Okay, Divya, Yatin, very good answer. Yes, Divya, your observation is correct, beta. It is a DuPont model. Yatin, your answer is correct, beta. Harshad Gohil, your answer is correct. And again, Divya, your correct answer. Very good, very good. Okay, student. Now let us see this question. I am just throwing back again this question to you. Okay, I just try it. Just give me the answer. I am just waiting for 2 minutes. Let me check whether I have received any answer. I think student must be typing. Very good. Very good. Divya, Radha. Very good. Divya, let me check better your another answer because I am not so first answer and first manner that I have told. Let me check it. Yes, Divya, your both answers are correct. Very good. Okay, very good. Divya, Radha, very good. Very good, beta. And Naveen has also given correct answer. Very good, beta. Okay, student. Now I share with something with you which will make you more clear what exactly the difference between external growth, sustainable growth rate or external growth rate. I'm just sharing some. Just I'm stopping here. I'm sharing with you. I'm just showing with you. Just one moment. Okay, students. Now here required external funds. Okay. Here I take projected growth rates. So see here, if my external funding requirement is below here, okay, so at this point, when I am not using any external fund here, this point will called IGR, internal growth rate. Okay. Now, if I want more growth above this, so this will be the required external funding. Okay, student. So you can see till the point I am not using external funds. So whatever growth rate will be there, this will be my IGR, and after that it will be the required rate of. Okay, student. So I hope the concept difference between SGR and internal growth rate must be clear to you. Now I'm just taking a small break. It is 8:51 by my watch. I will come back around 9:1 or say 9:2. I will be there. Okay. So meanwhile, what we have discussed, you can continue to revise the same. And if you have any query, just send it me. Okay. Mr. Mansukh, technical team. जस्ट आई एम टेकिंग ए ब्रेक ओके ये जो स्लाइड आ रही है ना इस पे शेयरिंग पे इसको रहने दो कंटिन्यू रहने दो ठीक है ना इसको कंटिन्यू रहने दो बेशक ठीक है बच्चे से डायग्राम बना लेंगे ओके थैंक्स स्टूडेंट आई जस्ट कम बैक Welcome back, student. Now, before I proceed further, let me check if I have received an query. Very good. More student have given the answer, Naveen and Yatin Kamlesh. Okay, student. So let us, I think the concept of this must be clear to you that I have discussed with you. Now, I am coming to the question of the day, last question of the assignment. Please read the question carefully. Now, question says like that, the following financial data are available for PKWR Limited for the year 2008. Okay, the debenture figure has been given to you. 10% debenture bonds have been given, that have been issued in 2007. Equity share, reserve and surplus, total assets, asset turnover ratio. Okay, then effective interest rate has been given to us, so we not to worry about the same. Effective tax rate has been given to us. The profit margin has been given to us. Dividend payout ratio has been given, and even our has been given current market price, and even the expectation of the gain. So I think we will not need the both items. Okay, we can say that mainly we are concerned with up to this item. Okay, student. Now it says we need to draw income statement for the year and calculate its sustainable growth earning. Okay. From the data given, first of all, we calculate the income statement. I think we should draw it on the next sheet. Okay, madam. Now let us prepare. First of all, we go by the figure of sales. So we have to compute the sales. Our total asset is 600, and asset turnover ratio is 1.1. Okay, so accordingly, $600. Okay, student, not an issue. Now our operating expenses is, operating margin is 10%. Okay, so our operating expenses is 90% of the sales. Okay, student. Now from this is earning before interest and tax. Now our effective interest rate is 8%. Okay, so we combine the same, that is 175 or 8%. The figure comes 14. Okay, the figure comes 12.52. This is earning before tax. That's dividend. Now here, student, please pay the attention. 16.67%. Okay, the figure comes 5.2. So the balance will be our retained earning. Okay, now we compute the sustainable growth rate. It is ROE into 1 minus D. Okay, beta. Now how we compute the ROE? Here with the given data, we compute profit after tax because this is PAT. I forgot it. Okay, this is PAT. PAT divided by equity net worth. Okay, here our PAT is equal to this much amount, 31.20. Net worth is equal to 400. Okay, so ROE will be 7.8%. Okay, and SGR will be or 6.95%. Okay, student. Sir, what is effective interest rate? Let us see here. Effective interest rate means, actually, if we go by the question, you see here. Now the debentures have been issued at somewhere around 8%. Okay, the bonds have been issued at around 10%. So basically, if we see, if we compute, say, the 10% of 15, so it comes 5. Okay, and if we see here 8% of this is 125, so it becomes 10. Okay, so the total amount becomes 15. Okay, let me show you here. So if we compute that way, 15 divided by 175 into 100. So somewhere the figure will be around 8.57. But since these bonds have been issued in the year of 2000 only, and this year this is 2008, so there may be possibility that they maybe have been issued somewhere in between the 2007, and we are may not be paying the full interest year of the interest to the these bonds. Okay, that's why we have taken here 8%. Very good. Mutha Lakshmi, your answer is correct. Okay, student, if you have any doubt, you can discuss with me so that I can proceed further, because this topic will be over. Now I will take up another topic, risk management. Okay, I think there is no inquiry. Now I am just proceeding further. One minute, student. Let me open my PPT. So let me just share my PPT, then I will close the session. Well, we could not close the session, close this portion. 1 minute. I have something I want to discuss with you. Student, you see, this type of variety of questions are normally asked in the examination. Okay, so normally till now the theoretical questions have been asked. However, some numerical question has been covered, so I have covered with you. So these are normally short questions are discussed in the examination. Okay. Now I am coming to next my PPT. Okay, student. Now I am taking you to the next topic, risk management. Students, see, this topic is basically consists of two portion. One is basically various types of risk, analysis of a various type of risk, and another is value at risk. So, student, today in today's class we shall cover one portion, that is risk. What various types of a risk normally we face in our organization, and that where we, a CFO has to take the decision. And the remaining portion of value at risk we shall cover in our last classes. Okay, there will I will take up this last classes, or other faculty may take value at risk in more detail. Okay, so let us first start with first of all, when I talk about the risk, what exactly we mean by the risk. Now, student, please note, the risk means it is not only always, because whenever we talk about the risk, always a loss come into our mind. No, risk means deviation from the expectation. Deviation from the expectation. It can be anyway. It can be anyway. It can be your, say, if you are expecting profit but you are having loss. Okay. Now it because whenever we say the word risk, it means deviation from our expectation. Now, when we talk about the various types of a risk, one of the very prominent risk is the strategic risk. Just read the slide carefully. Then I discuss with you what exactly the strategic risk is this. Now, it is a risk in which a company's strategies become less effective and it struggles to achieve its goal. It could be due to technological changes, a new competitor entering the market, shift in the customer demand, increase in cost of raw material, or any number of other large-scale changes. Leading example, lost business of the Kodak and the Nokia phones. See, student, what happens? Strategic risk is the prime importance, because now what happens, it depends on the, because there are many factors like choice of the customer demand, market, what is, and any new policy. Okay, now I'm just giving you a very simple example, and it is a very practical example nowadays. With the this pandemic that is took place in 2020 in March. After that, the business of the hotel industry, okay, has come to an end for some say around 7 to 8 months. Okay, even cinemas, okay, theaters, all have been closed, shut down for some time. Okay, because there are no customer was there, and they are not allowed to enter into this all these hotels, etc. So by this, ultimately, the change in the circumstances, ultimately the company, even in some cases, some companies have to shut down their businesses because they are not getting the revenue. However, on the other side, this pandemic has proved a boon for the this IT business. Okay, so that's why we can say that sometimes there is change in such a market or demand that it creates the existence of the business itself. Just a very Kodak example is a very you can infamous example in this regard. What happens? The Kodak in somewhere around in 1975, they have invented this concept of digital photo that we normally take on our mobile phone. Okay, but what happened? They did not pay attention to this business more. Okay, they continued their business on the paper. Like there used to be film roll. If you ask your father, and I think you maybe remember that when you were a very small kid, so there used to be a small camera where there used to be a roll, and in this way we used to click the picture. Okay, nowadays the clicking of the picture is a very simple job, very child's play. Okay, even any child can take the pic and send you anywhere. But at that time there was procedure that you have to take the picture, then you have to again roll it, then take another picture, then you have to got this film developed. Okay, from the this is photo lab, and they used to charge some money for this printout. Okay, so they have continued with their own business and on the thinking that they are ultimately leaders of the market. But what happened when the other companies came out with this digital picture like Sony, Nixon? So ultimately, what happened? The Kodak has been bankrupt. Kodak has become bankrupt. Once upon a time, this company was number one. Then they become bankrupt. Okay, similar case with the Nokia. Nokia was the first company who has come out with the mobile phone with this push button, but they could not keep a lead with the on a touch screen or smartphone. So ultimately, there nobody today. Nokia's name is nowhere anywhere. Okay, but Samsung has identified this opportunity and they have come out with this touch screen mobile. Now, on the other hand, there is one company like Xerox. They have perceived the risk before, okay, because the Xerox company invented the photocopying machine. Okay, with the coming of the laser printer somewhere around in 90s, they have jumped into the business of the developing laser printers. Of course, Xerox laser printers are also very well sold in the market. So that's why they are surviving. So strategic risk means you have to change, because you may have one objective, but to meet that objective, you have to struggle hard. You have to see what is the market demand. Okay, now the days have been gone where there used to be long queues, etc. Now everything is on online. Okay, if any company wants to grow, they have to, of course, they have to come on the online, because now the customer is want everything at their own doorstep. Okay, so this is called strategic risk. Now there is another kind of a risk that is called compliance risk. Now in this compliance risk, just read the slide carefully, then I discuss with you. Meanwhile, let me check. I have received an query. Sairam is asking, sir, EFR in the study material from which chapter? Student, Sairam, and for other student, I am mentioning that exactly EFR is not covered in the study material, but since the chapter question has come in the January 2021 examination, so I have covered here because ultimately it is relating to your chapter number 1, financial planning. So that's why I have covered here. You will not get the material there. What I am shared with you, we have discussed in the slides. That is the material for you. Of course, I will share some notes. Don't worry about it. Okay, student. Now, what are the compliance risks? Compliance risk is basically the risk relating to the compliance with the rules and regulations. Because what happens when suppose if I am an income taxpayer, okay, I am an income PAN account holder, and my income is above the tax limit. Now, if I am not filing the income tax return, so I am taking the compliance risk, because tomorrow I may be received a notice from the income tax department. So accordingly, in case of a companies, they have to comply with the various requirements of like Companies Act 2013, okay, SEBI guidelines, SEBI regulation. If your company is dealing in the foreign exchange, so of course you need to abide by the rules, SEMA rules. Okay, so all these rules we have to comply. Like for insurance business, the IDA, Insurance Regulatory Development Authority, IDA has given some guidelines. Okay, they have to need to comply with it. Okay, so that's very important, because normally the company is in the forex business, so they need to comply with the RBI guidelines also. So all these rules and regulations we need to comply in the day-to-day our business operations. So in case if it does not comply with them, of course the penalty will be levied on us. And even in some cases, it has been seen that the key managerial personnel, KMPs have been even imprisoned for the same. So it is very important that you have to see, and this problem is mainly in case where the company is entering into the new business line or a new geographical area, because there you don't know what exactly the rules and regulations are prevailing. So that's why what happens when any Indian or any MNC is coming to India, normally they consult here the CA firms, okay, the law firms, okay, to come to know about the rules and regulations relating to NRIs. I just give you a very small example. Whenever any NRI comes or settle down in India, first he consult any chartered accountant, because he wants to know what are the tax implications for my income that I am earning here or outside. Okay, so that's why the compliance with the local rules is a very important, and that's why if it is we are not complying with it, is we are running a risk. Now next week comes the operational risk. This is very important risk. Just read the slide carefully. Now, business and operational risk related to the activities carried out within the entity arising from structure, system, people, product, or process. See, student, whenever in any organization, these are the main constituents: structure, their organizational structure; system, what are the policies and all the procedures are playing there; people, the persons who are their employees; okay, product, okay, what are the product they are using; and the processes. So ultimately what happens if there is any fault in this any of these of item, or their problem is any, so your company is taking the operational risk. Operational risk can also be defined as a loss. Is basically the Basel definition, that is Bank of International Settlement. The risk of loss resulting from inadequate or failed internal processes, people, and the system from the external events. So normally what happens, we can say that whenever the system of the any organization is a fails, then this risk is evitable there, because it is basically kind of a, of course it is from the external sources also, but more internal sources plays the role. Okay, in this case I just quote you a very interesting case study, Barings Bank. Okay, just you read the slide carefully, then I discuss with you what exactly this case is about. Okay, student. Now I will invite your attention to most. This is the last point of this. This is Ford Magazine's quotation. One of the most glaring regulatory error in the bank was having the same man at a helm of the both derivative trading desk and clearing, settling, and accounting operation. Student, normally what happens in any treasury department? Okay, if you are maybe going to some companies, big companies, they have a their treasury department. In treasury department, normally they have a three portions. One is front office, mid office, and then is a back office. Okay, so what happens? Maybe I just show it on my slide other also. One second. Then it will be more clear to you. Just hold for a minute. Now, students, see, in a treasury department, there are three portions. This is called front office, this is called mid office, and this is called back office. Okay, in front office, normally these are the persons are there who carry out the trading. They carry out the normally trading. So whatever the trading they carry out, like this trading can be in currencies or derivative instruments that we shall discuss. So ultimately, they send their all details to the mid office for the settlement purpose. Okay, After the middle office clears the settlement, the papers comes to back office. Normally they carry out the accounting portion. Okay. Now in this case, Barings Bank's case, what happened? This Nick Leeson was basically in charge. Basically, what happens practically, this front office in charge is separate from the mid office and this branch office, back office. So what happens if any fraud is committed here, it will be noticed at mid office. Okay, because there may be mismatch. Okay, if even both have been collided, then this can be catch at back office, because entry will then it will reflect in entries, because bank there is very non-reconciliation of bank statement. Okay, now in this case, in Barings Bank's case, what happened? He was in charge of front office as well as mid office as well as this back office. So ultimately, he has started trading not fraudulently, he was carrying out some trading, but for margin call, he was using one account number. I think the account number was sometimes 5 times 8. This was the account in a back office, then maintaining one account for the some suspense account transactions. So whatever the loss, he is transferring this loss to this account. Okay. Now at one point of time, the company's loss has been more than its capital, and ultimately bank has been collapsed. So what is the reason? Because overall there was a problem like called there the same person had been made for in charge for all these business. So that's why this is called. This is a very prime example of this is Barings Bank case is a very prime example of your operational fraud where the lack in the you can say like that it is a kind of an internal control. It is a kind of a you can say it is a kind of an internal control, because in internal control the work done by one person is checked by the other person. 1 minute, I'm just coming back to the slide. Okay, student. There is another glaring cases, two cases. This is in context of India. Okay, there are two fraudulent transactions. Same. One is I'm not to tell you about a Nirav Modi's fraud, that is of 11,400 crore, and there is another misuse of the fund by Rotomac Global Private Limited of the 3,695 crore. Okay, so there are both cases. You can refer it from the website. Okay, these are cases are there that you can refer from the website. Then you will come to know what are the operational problems, operational lapses are there that scams has taken place. Okay, student. Now I'm coming to next very important risk, financial risk, and normally which we are concerned. Let me check if we have received any query so that 1 minute. Sir, I have heard this concept is also called Chinese wall. Prerna, I think it is called firewall. Maybe if I remember that, not Chinese wall, because I'm not well versed with the term. Maybe you may call it, but this is normally called the Chinese wall. This is firewall. We can say whether like where there is a the one person cannot enter into the arena of the other person. Okay, Chadev. Okay, now this risk is very important for us, and this you can say this forms a basis of this, because there are some major part of the topics of the discussion of the syllabus are on this based on the financial risk. Now, financial risk is referred as an unexpected change in financial condition such as price, exchange rate, credit rating, and interest, etc. Broadly, financial risk can be divided into following categories: counterparty risk, political risk, interest rate risk, currency risk, and liquidity risk. Now let us discuss one by one. Normally political risk is separate, but sometimes what happens, ultimately it results into the financial loss that much quickly that sometimes it is categorized as the political risk as a part of financial risk. Now first it comes the counterparty risk. Just read the slide carefully. The risk occurs due to non-honoring of the obligation by the counterparty, which can be failure to deliver the goods for the payment already made, or vice versa, or repayment of borrowing and interest. Thus, the risk also covers the credit risk, credit default by the counterparty. It is also called, there are another version. Normally, it consists of two risks. One is counterparty risk, counter risk. This is credit risk, and another is also called settlement risk. Now I will just show you just you read the hints, then I will discuss with you. Failure to obtain necessary resources to complete the project or undertaken, any regulatory restriction from the government, like other party cannot execute honor their obligation because of restrictions from the government. Hostile action of the foreign government, it is very common. Now suppose you have lended the money to any company who have established their project outside India. Now it may be possible that the government may become hostile and your money is gone. Okay, they cannot lend. Let down by the third party, other party may just take off the business, become insolvent. This is one of the very prominent case. So in this case, what happens when another party becomes insolvent? You cannot recover the money, and if recovery will be there, very less. Now the various techniques to manage this type of risk are carrying out due diligence. Before I just counter this, 1 minute, let's say. There is one very famous case for the counterparty risk, and these are 5 cases I have picked up from the net. It is one of the very famous case, State Bank case. In this case, what happened? Like when we talk about the foreign exchange, this will be more clear to you when we will talk about the foreign exchange topic. Now suppose if I want to buy the dollar, okay, for this I need to make the payment in Indian rupees. Okay, suppose if I make the payment to I'm just buying, say, foreign exchange for the I need the foreign exchange for $1 lakh. Okay, today's dollar rate is 75. So I will need to pay 75 lakh rupees to some party. Okay, it may be bank. Now suppose I make the 75 lakh rupees in the make the payment to in some bank. Okay. Now before the $1 lakh is credited to my account, this bank becomes fails or become insolvent. So in that case, what will happen? My 75 lakh rupee will be stuck up there. And same thing has been happened with these 2 cases. Okay, where before they have taken the 1 point for the one party, and before they could transfer the money, they have become insolvent. So normally this has been happened, and in case of a Soviet coup in 1991, those who have taken the money in exchange for exchanging the dollar, they have not transferred the money because of not knowing what will be the government reaction. Okay, barring bank in case, what happened? As I discussed, the bank has failed. So people who have deposited the money for exchange of dollars, their money stuck up there. So these are also called the settlement risk. This is an example. This is in counterparty because the other party has become insolvent. Okay, so this is very leading examples that I have taken from the net. Okay, this is now what are the methods? How can we manage this risk? Okay, carrying out the due diligence before dealing with. Yes, one important more point, student. Now some student will say, how can we avoid this risk? Settlement can be risk avoided by using the continuous linked settlement. Nowadays there is a continuous linked settlement there because there is continuous settlement linked window there, continuous link settlement window is there, which is open for the some to 4 to 5 hours. In this case, what happens? Whatever you have transferred the money, in return of the same money, exchange of the same money, you will be get back your other currency. If the other party does not release the money, so it will be get back to your account. So somewhere now this risk has been minimized. So these cases were very common prior to somewhere around 2000. Now after the 2000, with an increase in technology, this risk has reduced to minimum. Another is counterparty risk. The various techniques to manage this risk type of risk are this: carrying out the due diligence, very important. Just carry out the due diligence of your the borrower. Okay, not do not commit to a single entity or group on a connected entity. Never deposit your money in a one bank account. Total money, just spread your money. Okay, know your exposure limit. Exposure limit normally use in case of like you put a cap on the trading, like it is more common in the foreign tax of the Treasury Department, because there every trader has been given a limit that after that you cannot go for, like when we should proceed further, you shall see in a foreign tax normally whenever any bank is involved in treasury function, so they make a purchase or sale of the foreign currency. That you will find the examples when we shall discuss the topic of foreign exchange. So there every trader has been given a limit that you cannot sell or buy more than $5 lakh to cover up their exposure. Okay. Review the limits and the procedures for the credit approval regularly. So whenever any company is lending the money or they are entering in a transaction, so you have to see whether whatever limits we have prescribed, that should be followed religiously. Now, rapid action in the event of any likelihood default. Somewhere, if there is any chances that company is going to default, so just bring out your own money. It is also called bank rush. Okay, if there is any news come out that any bank is going to fail, so there will be a huge queue outside the banks. Okay, for of the depositor to get back their money. I remember, I think 3 to 4 years back, there was news regarding some bank that is going to fail. So I remember that there were long queues, and it hasn't come into the news. Use of performance guarantee, insurance, and other instruments. These are hedging instruments. Normally, performance guarantee is taken by any other party, like letter of credit. Okay, the insurance we can take for the insurance and other instruments. So these are the cases. Now we come to the political risk. Now, this type of a risk is faced by an overseas investor as adverse action by the government of the host country may lead to huge losses. This can be any one of the following form: confiscation or destruction of the overseas properties. This is somewhere has been found in early 70s, where some countries in Africa has done this action. They have demolished their projects. Rationing of the remittance to the home country. It is very important. Like what happens? Suppose a country want to invest in another country. Okay, country's company. So earlier in India, there was also restriction. And earlier there was a restriction in India also. If any foreign company is coming here and they have to take back the profit. So there was used to be some restriction. Okay, of course today there may be some restriction, but this is called rationing of the remittance to the home country. So sometimes this rationing is declared all of a sudden. Okay, no MNC will be allowed to take back their more than 50% of the profit earned in India. So ultimately 50% money they will be halted in India. Restriction of the conversion of the local currency of the host country into the foreign currency. If suppose any company MNC comes here, they get converted foreign currency into the local currency, then they start their business, and once they earn the profit in the business, now what will happen? They will prefer that they convert this host currency, the local currency of the host country, in the foreign their own currency. Okay, so it may be possible that the government may put the restriction. Okay, restriction as to the borrowing. Okay, the government can place a restriction that you cannot borrow the amount. Invalidation of the patent. Sometimes the patent or the copyright can be declared invalid. Okay, price control of the product. It can be put restriction on the MNC that you cannot sell this product more than its price. So ultimately their profit will be shrink. So all these are kind of a political risk. Now, these are the methods by which we can eliminate or we can reduce the political risk. Insistence on the resident investor or the labor. It is always better. You involve the local labor, okay, and you involve the local investor, because once you will involve the local labor, what will happen? Your business cannot be shut down very easily, because it will ultimately affect the local public. Okay, and due to political reason, it may be possible that a company may not go for this option. Restriction on conversion of currency. Okay, so you place yourself on restriction. Okay, you just convert very limited amount so that you will not invite the government attention. Expropriation of the foreign assets by the local government. 1 minute. Sorry, my mistake. I have 1 minute. I just take it. I'm just sorry, my mistake. I want to say that what are the following actions of the government of the country can be identified. Now, these are some hints. Okay, that you can identify the risk. Insistence on the resident investor or the labor. They insist that you will need to employ the local labor. So by this, the performance of the company can be mitigated. Okay, restriction on the conversion of the currency that I've discussed. Expropriation of the foreign assets by the local government. Normally it is a confiscation of the assets of the company by the local government. And very important, price fixation of the product. Now I am coming how the company can risk and they can assess the risk by referring the political ranking published by the different business ranking. Now there recently there may be some index like ease of doing the business in the newspaper. So that type of a ranking index you can refer. Okay, there are like Gini coefficient and corruption index. So these are some benchmarks that can be followed by evaluating countries' macroeconomic conditions like growth rate, okay, foreign exchange rate, all these factors, by analyzing the popularity of the current government and assess their stability. Now it is very important. Whenever it has been seen practically, whenever any stable government has come into the India, the impact on the business has been positive. Some political turmoil in India, and after when the another government, Congress government, has come into the power, so there was a positive, considering the stability. There was a boom in the business at all overall, and even the foreign currency countries have started investing in the money in India by taking advantage from the embassies of the home country in the host countries. Embassies are the best sources. They know the local position there. Okay. Now, these are the techniques that can be used to mitigate the risk. Local sources of the raw material and labor, that is more important. You employ the local labor. Okay, you employ the local labor and use the raw material there, because ultimately this will be the business boom for the other small subsidiary business houses also. Okay, like very frankly speaking, just give a very small example. The companies, when the foreign companies have come into the this MNCs, BPOs have come into the in our Bengaluru, and this is Gurgaon, Gurugram, Noida, Hyderabad. So when these companies have come there and established their business, so ultimately nearby taxi operators, okay, small restaurants have gained the businesses. Okay, because and ultimately what they are employing the local labor, because they are employing even the young generation got the job. So by this, the risk can be mitigated. Entering into the joint venture, that is one of the very good tool. You enter with the joint venture, like you enter with their government joint venture. So easily government cannot get you out from the country. Local financing, use the local funds. Why are you investing your own funds? Use the local funds. You take the loan from the local bank, because if the government will be confiscated, you will be not at loss. Prior negotiation, generally this happens in the case of a government. Then they enter into, before entering into the business or investing their money, they take a commitment from the existing government that their business will not be affected. Now this is one of the very important interest rate risks. Just read the slide carefully, then I will show you how interest rate is affected. Now, student, if you see the slide, the risk occurs due to change in interest rate resulting in change in asset and liabilities. This result is more important for banking companies as their balance sheet items are more interest sensitive. Their base of earning is spread between borrowing and lending the rates. Okay. Now just I discuss with you, and there are two type of risk: fixed and floating. Fixed and floating, and risk in both of these type of is inherent. Student, there are 1 minute. Let me just I will before I proceed further. I'm just taking you what exactly this risk is all about. Now, student, interest rate risk is more important in case of a bank because it mentions a spread. Spread means difference. Now, what does the bank do? The bank basically lends the money and borrows the money. Okay, the borrowing interest on borrowing is chargeable. Okay, and interest from lender, sorry, interest if it borrows from depositors, is their income. Okay, now because say for I'll just give you example. If Mr. X makes a fixed deposit at say 6% with say ABC Bank of rupees 1 crore. Now suppose Mr. Y goes to the bank and wants a loan. So bank say gives a loan at 10%. Same bank. Okay. Now ultimately this difference 4% is the income of bank. Okay. Now tomorrow what happens? The rate of interest become in the market 8%. Mr. X says I want to encash my FD. Okay, I want to encash my FD and just give back my money. Okay, I will invest at a 6% because the investment is at 6%, but I will want to invest it at 0. So, but Mr. Y will not say and say borrowing interest rate has become 12%. It may be possible that Mr. Y may not say I will refund you at this loan and I will take another loan. Mr. Y will continue at 10%. So in that case, if Mr. Y continues at 10% and Mr. X get new FD at 8%. So this shrinking of interest, here you see the here the spread was 4 and here it has been shrink to 2%. So that's why the bank are more sensitive to the interest rate risk. Okay. Now there is another thing I'm taking the version. Now interest rate risk happens in both cases. Fixed example I have given to you. Okay, you have made some fixed commitment. Of course, there is a risk. Okay. Now I am coming to the floating. Floating means that keeps on changing. Now suppose today I invest in a bond at 7%. Okay, this is a fix. So if the rate of interest becomes 9%, this comes a fixed category. Now if I say floating rate bonds, okay, suppose I am given the choice, and this especially happens in case of a home loans. Okay, the company may give you the bank may give you the choice. Either you can take a loan at just I'm taking a case of a home loan, will be more appropriate. The bank is giving me the choice that you can take a home loan at 8%, or you can take it floating rate. Okay, this floating rate can be say benchmark rate plus say 2%. Okay, so the benchmark rate is say 5%. Benchmark rate normally we can say it is a bank lending rate. It is a bank lending rate. Okay. Okay, it is a bank lending rate. So repo rate. Okay, so it can be repo rate. So now here say 5% is repo rate plus 2% here. Okay, now what happens? Here I have been given the choice 8% and here it is ISL. So today I say I am taking the loan at 7%. Okay, because I am taking the floating rate. But tomorrow say benchmark rate becomes 9%. So how much I will have to pay? 11%. Okay, so by this I can see that there will be loss to me. Okay, so how much I am paying extra? 3%. Okay, now there can be a possibility. I just give you another example for interest rate. Say I have invested 8% bond money, okay, at a face value of 10. Okay, now tomorrow say interest rate becomes 10%. Okay, now if I am getting rupees 8 on my bond, so see today the rate of interest is 10%. So say for 10%, I have need to invest money 100. For one, I need to invest money 100 by 10. And for if I am getting 8 rupees, then how much money is justified? 80 rupees. So the value of my bond has been decreased from 100 to 80. Okay, so this value deletion is also called the interest rate risk. So I hope it will be must be clear to you. Let me check any query so that I can proceed further. Okay. Let me share the screen. Okay, student. I hope with this must be clear to you. Now I am coming to another topic quickly so that we can come to an. Okay, these are hints. Okay, beta, these are the methods. See, interest rate is method and currency risk all will be discussed when we shall take up the topic of the foreign exchange. Now, before I end the session, I'm just discussing with you the one of the important risks. So it has not been covered in your study material, but it is one of the very important risks. Now, cyber risk has become one of the very important risks nowadays, because with the pandemic, the use of the internet has become very vital. Even now, I remember before this taking this all classes, we used to take the classes in the room, and where we used to write the talk or whiteboard, etc. But now the time has changed. What we are doing on an iPad. Okay, and due to this iPad, there was some problem. So this was because you have seen that some other screen has opened automatically. So this kind of a risk is called cyber risk. Okay, this kind of a risk are called cyber risk, because sometimes there may be some problem in our system, IT system. So just read the slide carefully. The exposure or the loss resulting from a cyber attack or data breach of an organization. Okay, so normally this what happens, say data breach, even the you have the study read in the newspaper that the data of the 1 million customer has been leaked. Okay, so all these are example of cyber risk. So ultimately what is they are resulting into the embarrassment to the customer. Okay, of course, and there even some system have been hacked, they have been put on the hold, and the ransomware attacker has demanded the money. So this may be due to the poor IT system. So student, I hope that discussion on the risk must be clear to you. Currency risk and interest rate risk will be discussed more in detail when we shall take up the respective topic. Okay, so today we are ending our session with this, and now we are just, I'm just sharing my email ID as well as my phone number, so that you can share it with share your views, and even you can ask your queries. Okay, student. So till in the next class, we shall meet there. And day after tomorrow, there will be a class of security analysis, and CS Vivek Banerjee shall take up your class. Okay. Till then, whatever you have studied in the class today, just cover it up in your studies. Okay. Thank you. Have a nice day.